Welcome to our 9th ESG webcast concerning ESG reporting, CSRD and ESRS. This webcast is an update to our 4th webcast on the same topic. My colleague Julia Övalle and I will guide you through this webcast. Before we dive into today's topic, don't forget to subscribe to our channel to stay tuned on new episodes of Let's Go ESG. As you already know from our previous webcasts, the Corporate Sustainability Reporting Directive, or CSRD, is the basis for mandatory sustainability reporting in the European Union. The CSRD is an EU directive that entered into force in 2023 and must be implemented into national law by the respective member state. In Austria, the implementation is still pending, while many member states have already implemented the directive. The CSRD leads to a significant expansion regarding the scope of the sustainability reporting obligation, which means that considerably more companies are obliged to report than before. Furthermore, it also leads to a significant expansion regarding the sustainability-related information that has to be disclosed. In order to promote the comparability of sustainability information, the European Union has published its own reporting standards, the so-called ESRS, European Sustainability Reporting Standards. Like financial statements, sustainability reporting is also subject to external audit. Until now, large stock-listed corporations, credit institutions and insurance companies were required to submit sustainability reports in accordance with the NFRD, Non-Financial Reporting Directive. As of financial year 2024, these companies will be subject to the more comprehensive sustainability reporting requirement under the CSRD. Starting with the financial year 2025, all large undertakings will also be required to report in accordance with the CSRD. This will lead to a significant expansion of the sustainability reporting obligation. Here, I would like to point out that the size criteria for large undertakings have been adjusted at European level due to inflation. The criteria of balance sheet total and net turnover were raised from 20 and 40 million to 25 and 50 million euros. The size criteria regarding listed SMEs have also been adjusted by the European Union. For more information on the size criteria relevant for CSRD reporting, please watch our 4th webcast. The sustainability reporting obligation also applies to certain companies from third countries. Moreover, it should be emphasized that subsidiaries in group structures may be released from reporting if the parent company prepares a consolidated sustainability report. However, this has to be checked in each individual case. The sustainability report in accordance with CSRD and ESRS, as well as the disclosures in accordance with the EU taxonomy regulation, must be disclosed as part of the management report in connection with the annual financial statements. As already mentioned, these contents are also subject to external audit. The same also applies in case of consolidated sustainability reporting with regard to consolidated financial statements. As mentioned above, European standards have been developed for sustainability reporting. My colleague Julia Övalle is going to tell you more about the ESRS, European Sustainability Reporting Standards.
The ESRS are mandatory for companies that are obliged to report under the CSRD. They are divided into general and topical standards and cover various ESG topics. In addition to 5 environmental standards and 1 governance standards, the topic-specific standards include 4 social standards. The ESRS are sector-agnostic and are to be expanded by 2026 to include sector-specific standards standards for listed SMEs, and voluntary standards for all other SMEs that are not obliged to report under the CSRD. The general standards ESRS 1 and ESRS 2 cover general requirements and disclosures on reporting. ESRS 1 general requirements regulates the principle of reporting, such as qualitative characteristics of information, time horizons, and in particular, the principle of double materiality, which I will discuss in more detail. The double materiality assessment is the core element of the ESRS. In the course of the double materiality assessment, material topics in the area of environment, social, and governance are to be identified for the respective company. These topics must then be assessed in terms of impact, risks, and opportunities. Finally, companies must report on their material topics in accordance with the relevant topical ESRS. The principle of double materiality requires sustainability topics to be considered from the inside-out perspective, also known as impact materiality, and from the outside-in perspective, also known as financial materiality. Impact materiality takes into account actual or potential, positive or negative impacts or business activities on people and the environment over a short, medium, or long-term horizon. Financial materiality considers the effects of sustainability aspects on the company's financial situation over short, medium, or long term, and the resulting risks and opportunities are recorded. Topics are classified as material if they are material in terms of one of the two dimensions: impact materiality or financial materiality. As the double materiality assessment is a process of several months, therefore, companies that are required to report under CSRD in 2025 should start the implementation early in order to be able to collect all the data required by the ESRS in time. Now I would like to discuss the topical standards. The ESRS contains 5 standards relating to the environment. ESRS E1, which contains information on GHG emissions and energy consumption, is of great importance. Other topics covered by these standards include pollution, water and marine resources, biodiversity and ecosystem, and circular economy. The environmental standards are followed by 4 standards relating to social matters. ESRS S1, which regulates information about the company's employees, is of particular importance. This standard includes, for example, metrics on the diversity of the workforce and information on training hours. There is only one standard on the topic of governance. This deals with topics such as lobbying activities, corruption and bribery, and business conduct. Finally, I will show you an example of the structure and the individual disclosure requirements of an ESRS standards based on ESRS E1 climate change. The standard is divided into 4 reporting areas: governance, strategy, impact, risk and opportunity management, and metrics and targets. At the beginning of the standards, there are disclosure requirements that are related to ESRS 2 general disclosures. This is followed by topical disclosure requirements such as information on GHG emissions. This brings us to the end of our brief insights into the topic of ESG reporting, CSRD and ESRS. Please also have a look at our previously published webcasts, for example on the corporate carbon footprint or ESG topics for SMEs. If you enjoyed the webcasts, we look forward to seeing you again next time.